Okay, good day everyone. Welcome to another section of our class. So today we are going to build our income statement. So we'll start. Remember this our dashboard. Then we'll go back to our pivot workings. So we'll create a new sheet and rename this sheet income statement because we are building our income statement now. Now go to our pivot workings. Here we have this our row. These are setting, copy it, come to the income statement, then paste, paste value. Just paste it anywhere there. Okay. Now we'll only be working with the January 2023 data. Won't be needing this other data. So it's off. So we're only working with 2023 data. So we'll first build, I'll copy this, I'll control C, then come down here and paste. But this time around, I will transpose, paste as transpose, not as, you see what just happened. So paste as transpose. So that's the whole figure there. So we are building. So I'll, after that, let me build my date. So this is, I'll call the company name. This is an income statement, okay, for the period in January. We'll name it, let's name ABC group of companies. Mhm. And this is for the period. Remember, it's 2023. So we say income statement for the period January 2023 to December 2023. So we are building. So let me quickly merge this and center it. Come to this also, image and center. So we are building. Then cannot take this one off. Then what is an income statement? I said an income statement an income statement. It shows how much money the company made and how much they spent over a period of time. And also it's sometimes called the P&L, the profit and loss statement. For an NGO, it's called the income and expenditure account. So they are called different names based on the company and the policies they are using because of industry standard. Then components of an income statement. We are building our components of an income statement. We have, let me write here, components of an income statement. So components of an income statement. We have the revenue, sometimes revenue, sometimes we have sales, and sometimes we have what we call gross value of merchandise. All these are used interchangeably, but all these are actually they are not the same, but they are used frequently interchangeably. It all depends on it's due to industry standard and their policies. Sales revenue, those GVM are often used interchangeably. So I will explain all and why they use them. Sales, for our sales is simply income generated from selling products and services. Income generated from selling products and services. That is sales. Let me increase my screen a bit. Sales is income generated from selling products and services. What about revenue? Let me talk of revenue. Now, what is revenue? Revenue are all income generated by the company from its business activities. It includes the sales, it includes the interest, it includes the dividends. That's revenue. So let me write it out. These are incomes generated by a company from selling. Let's see, from all its business activities, which includes the sales, the interest, etc. So that's what an income is. It's usually recorded as the gross amount and then later discounted for discounts, allowance, returns. All those things will later be deducted from the revenue, and at the end you now see net revenue. So it's incorporate just like our sales is just sales. It doesn't include just it includes the discount inside the sales. The returns is also included in the sales. The allowance, they are included in the sales. But when it comes to revenue, they are included, but along the line we will now subtract them off from it. Then what about the GVM, the gross value of merchandise, also called GVM. So I said is the total value. It should normally use in a retail company. So is the total value of merchandise sold. The total value of merchandise sold, which includes the cost of goods sold, the returns and allowance and discounts. So GVM. So I've been able to explain all this together. So the revenue, the sales, the gross value of merchandise, they are all the same. They only vary when it comes to the industry you are working with or and their policies. So Control C, Control V, Control B. So let me copy this ones, Control S and paste here. Yes. So that's So as I was saying, components of income statement, I said we have the sales because we only have a sales data set here. So we have the sales, we have the cost of goods sold, we have the gross profit, we have the operating expense. Operating expense, they includes, and you see the depreciation there, depreciation, we see the depreciation, we see the amortization. I won't go deep into that. We see the salaries, we see wages and salaries. Um, which other? We see the marketing expense, rent. We see the rent. We see the utilities. The utilities. I think we are okay with that for now. So all these now are operating expense. So let's say yeah, after that we now see the interest, and we now get finally we have the tax and we have the net profit. So in building them, we already know how we got to this aspect. So I will take this one off now. I can, for better visibility, let me just change this to numbers. Okay. So now I will insert a column here. This is our revenue. This is our sales. If you can remember, this was our sales. So here we have our sales. Now I said next after the sales we have the cost of goods sold. It's sometimes called the COGS. Yeah, COGS and something. So we have the cost of goods sold. Then next we have the gross profit. Gross profit. Then after the gross profit, we now have the operating expense. Mhm. Yeah, the operating expense, I said, let me bold in it. It includes the depreciation. We don't have depreciation here, so I won't include the depreciation. So I'll go with salaries. We'll go with marketing expenses. Marketing expense. I will go with rents, um, utilities. I think that was all we have for. We have the salaries, marketing expense, utilities, yeah. The tax will come in later. So now let's say this is now our this all these makeups are total operating expense. Mhm. We are coming down there. Then after the total operating expense, next we will now have the interest. But before the interest, we have what we call operating. We have the what we call operating income, or let me say operating income, or we sometimes use earning before interest and tax, EBIT, earning before interest and tax. And then this is the earning before the interest. Then we now have the interest. Now we have interest charge. Then after the interest charge, we now have um earning before tax. That's EBT. Then we now have the tax charge. Then after the tax charge, we now have the net profit. We are building. So net profit, net income. Now all this now. So let me create. We'll be working with assumptions because all these data we are not provided. So let's work with an assumption. We know rent, utility, rent and salaries they don't usually change. They are mostly fixed. They are fixed, but they are not variable component like the marketing expense, the utility bills, all those varies. But when it comes to fixed, we know the salaries are mostly fixed and the rents are fixed. So we'll create assumption. let's use for this now. Let's use some assumptions for this. Uh-huh. Oh, I got it all wrong. This should have come here. Control X and Control V. This should have gone. So now I say we'll create assumptions for all this. So not all this, all this. Control C. Let me paste here. Control. Let me paste E here. Control V. So as regards to assumption, what are we using? Cost of goods sold. Let's use 20% off. Let's use 20% for cost of goods sold. No, gross profit is, we won't be needing that. It's self-generated. And salaries, let's use um let's use 3 3% for salaries. Yeah, 3% for salaries. For marketing expense, let's use 7% for salaries. For marketing expense, let's use 3%. For rent, let's use 2%. Utilities, let's use mm, 1.1%. Mm, or let's still use 2% for utilities. Total operating expense, this one will be generated on their own. Earning before interest and tax, this one will be generated. Tax, let's assume tax is when you borrow the money, when you loan the money, you get the facility from the bank. But let's just assume a figure. Let's give it a fixed figure for tax. Um, let's say tax deduction is 2 million, not percent this time around, just value. 2. Now earning before interest. Now tax, let's say tax is, let's use 25% of, of our income. That will be what will be taxed on. So now remember this, I had to take it out so that we'll appreciate this later. So so let me create a figure here for us. Okay, it's already created. Now cost of goods sold. We told you I said we use assumptions. These are assumptions. Assump so for our cost of goods sold, we use 20%. We just do equals to this times this. That's the 20%. And this goes for gross profit is simply this, the sales less the cost of goods sold, the gross profit. Then our salaries, I say we are using 7% for salaries, which is equal to 7% of sales. Mm, let's use 7% of our sales. Marketing, let's use times 3%. Rent times 2%. Times utilities 2%. Then said interest we use to tax, I say 20%, 25% of our income. So now how do we go about this? Now we've gotten our gross profit, which is simply the sales less the cost of goods sold. That is how we got our gross profit. Then this total operating expense. this will only do equals to sum of this. We'll sum this up. These are operating expense. So this is our total operating expense. Earning before interest and tax. How do we got there? This is simply our gross profit less our total operating expense. That's our earning before interest and tax. So we now have our interest here. So earning before tax will now be equals to earning before interest and tax less tax deduction. We have our interest. Then our tax, I say our tax is 25%. And what do we tax on? We tax on our operating income, which is this earning before interest and tax. That is where we put our tax on. So this is equals to this times our 25% here, our tax, which is this. So our net profit will now be equal to this earning before tax minus tax. So that's our net profit. So, and we have to drag these formulas two down. We have to populate the other data, the other months using this same formula, but we cannot. So we have to take this off because of control. And so it will. So, and we cannot drag because those formulas we are not locked. For instance, watch, because if you look at here, F2, it's picking an MC. So we have to log these formulas again. So this is just F4 on your keyboard. It will lock, come to press, no, don't want. Then F4, click on the formula bar, F4, enter, click on the F4. Now let's go again. Let's now drag this formula down to December. Drag these two down to December. Drag this to December. I see salaries are usually fixed. So we'll work with this salary, Control C, and we'll paste value because they are usually fixed. So let's assume a round figure. Let's use 8 million. So let's drag this. They are usually fixed. Marketing expense. These ones are variables. The varies. Rent are usually fixed. Let's use 3 million for rent. Oh, that's much. That's a whole lot. So that's a whole lot. Utilities. Let's maintain the formula. Oh, was it? Oh, it wasn't locked. F4 on the formula bar, you lock it. Drag down the now we're getting there. This one is simply we'll drag it down. Any before tax, any before interest and tax. We also drag them down. Interest says fixed, so we drag it then we just drag. This one also is just drag. With tax, we drag down, and the net profit. So our dashboard, our income statement, it's ready. We've built our income statement, so it's looking good already. ABC Group of Company income statement for the period January 2023 to December 2023, and the above are the months and these are the times. Our income statement is ready. Thank you.